Okay, GM. Hope everyone's had a prosperous week punting in memory stocks and other associated parts of the uh, existing bubbles. Congrats. Look, this week I'm going to do a bit of a different topic. It'll be a short one, but basically, like, and this will mostly be aimed at like people running their own PA as aside from like if you're trying to get a job in the industry or something like that, this isn't going to be that helpful for you because the two are just remarkably different. But I think like the title will have is like, don't look at 13F's, do this instead, or something like that. Um, yeah, the 13F discourse always gets like a lot of play on Twitter just because it's just like one of those things that like seems to get a lot of engagement for one reason or another. People running big funds are like basically celebrities, and people know them, and the companies they own are like well known and topical. So there's always something to talk about in that regard. But um, yeah, to the extent that you're like a retail investor and you have the ability and the mandate to look outside of like the 20 biggest companies listed in America. This stuff is not that helpful. Um, it's interesting, like a cocktail party discussion to the extent that you have investing friends and whatever. It might be interesting if you already work in the industry, and being up to date on these things can be helpful in your conversations with your investors and allocators and so forth. But outside of that, like 99% of the time, worthless. um, and even to just push back on myself, the um the funniest thing about the current market, certainly the current market, as long as let's say millennials and even Zoomers have been around, is that many of these really large companies have performed well and continue to perform very well. There's probably no reason to expect that they probably won't. I got someone DM me a tweet I sent a few years ago where I said basically at the bottom of Google 3 years ago that you should find better ideas. You should have better things to pitch than Google, and you know, it's done incredibly well in the intervening period, and not surprising to anyone. A lot of small and micro caps have not done that well. So you can be right or wrong with these things, but I think in the main, a lot of these conversations are just are pointless, not that interesting, and unlikely to be like grossly mispriced. Um, like yeah, if you're a much newer investor, this is actually probably this has some efficacy in terms of you can kind of familiarize yourself with companies that before you take on any kind of speciality and uh, and that kind of thing. So I guess it's useful for that. But anyone who's really trying to kick the lights out, this is unlikely to be the most fruitful um, stuff to go and see. And it's just the problem that professionals are trying to solve is so much more different than the problem that are typically reasonable, well capitalized, uh, interested retail investor is trying to solve. If you're a younger guy and or gal, and you have much fewer resources, like you don't own a home, you don't have necessarily dependents, you may or may not have a spouse, girlfriend, boyfriend, whatever. Um, and if you're in a position of flexibility, then the probably the problem that you're trying to solve is that you're not wealthy or not as wealthy as you'd like to be, and you'd like to get wealthier at a much quicker rate than might be achievable elsewhere or on traditional pathways. If you're an older retail investor, that this probably you're trying to solve a different problem, which is probably to protect your capital in retirement and then generate a decent return, but maybe much more focused on the downside rather than the upside, and much more focused on things like yield than you know 10 bagging on your capital or something like that. So um, even within that range, professional investors are just trying to solve very different problems than it is that you're trying to solve, and they have very different constraints placed upon them. Um, if you're running, like if we take the business analysis lens and apply it to like a money management business, um, you wouldn't necessarily describe that as a high quality business. Money management is, or financial services, briefly, wealth management, whatever you want to call it, is these are typically not great business models, and probably even more to this point, to the extent that assets are managed in a active fashion, so that people are allocating money to hedge funds and growth mutual funds and single managers, etc. This trend has been going in reverse for quite a number of years, which might be disheartening for some of you uh, watching this. Certainly on the long only side, this to the extent that you're like interested in being a business owner and compounding over many years and owning good businesses and whatever, this is like there's a gajillion people trying to do this, unfortunately. um, I know this because I've met so many of them, and they're always so smart and had really great track records and all this thing. But you know, this is this is a well-worn path to try and raise money. And to be completely fair, I don't think it had a very good run um, in the last 20 years or so. And to be fair, I think that's where a lot of returns will be made over anyone's lifetime. But these things go in and out of vogue over time, and we've come out of a very long period where this has been in vogue, and now we're, you know, when these kind of assets do very well, a lot of people raise money to capitalize on this trend, and then the equities become people are become very they attract lots of investors, they get high multiples, people they're competing for these shares, and it kind of bids up the prices, and the all things being equal, the returns sort of have to they ameliorate. On the money management side, raising money for this stuff is diabolical, especially because there's very well established incumbents in the space. Like people were talking about Bill Ackman and Sir Chris Hone this week trading, Google and Microsoft. And those guys are extremely well known, and they're very successful, and they have a scaled fund management business already. And you kind of have to ask some of these questions, like you as an emerging manager, or you as the N of 10,000 equality long only fund. How are you going to compete? And it's just these things are much harder. Um, these things are a much harder proposition today than maybe they were in the past. And the so part of the like a very good money management business is sort of think about it as a marketing machine. And you kind of can tell this because the best people are the people who've been most successful at raising the funds, at least, while they might have had successful track records. That's kind of like table stakes. Having a successful track record is like the bar to start, and then being able to raise the assets on top of that, kind of contingent on kind of like a star manager, right? Like someone who's very charismatic, someone who's able to court the media, people who can get traction on Twitter, and so on. And maybe there's a bit of a chicken and egg thing there, but I don't think it's any surprise that the most successful fund managers are also basically like minor celebrities. You know, even Buffett, he's known well outside of the investment community. And you could say the same thing for Ackman. You could say the same thing for Sir Chris. And there's like an Australian example of this. There's a Canadian example of this, and so on. And so, after you get over the marketing hurdle, you have to keep the funds coming in. You're managing funds coming in versus coming out. You're benchmarked, you know, um, to whatever benchmark it is that you appeal to, or whatever benchmark your allocators are kind of setting against. And from the allocator side, you're kind of fitting a style bucket. They have a certain amount that's going to be allocated to growth equity, and another part that could be, hedge funds, another part that could be quant, and another part that could be private equity, and another part that can be um, real estate, and so on. Um, and so it's a continual battle. The really good hedge fund managers are, you know, if you had to choose between being a great individual investor and being a great marketer and money raiser, you'd be the latter. You'd pick the latter 9 times out of 10. If you can raise the money, you can hire talent. And you come to find that this is sort of how these businesses are structured. I've always been, uh, you know, I've been writing the blog for almost 3 years now, and I've met gajillion people. And to the extent that anyone who's a professional manager uh, reads, the guys are, they're usually the analysts doing doing the hard yards in terms of research. I almost never meet the principal of a fund, and I think that's just about right. Like, their job as the face or the CEO or the CIO, or whatever it is they call themselves. They're not talking to plebs like me. Unfortunately, I have no money to give them, and so it not so much of their time is focused on actually research, and for the most part, it probably shouldn't be. They'll have portfolio managers. Underneath the portfolio managers, there will be analysts, and those guys are putting the research together and talking to the companies, and they're not as focused on the front facing side of the business. And it's kind of like a software business in that regard. Like, the CEO and the sales guys are meeting the clients, and the software developers will never meet the clients. Never put a software developer in front of a client, because it's that's not relating to people, usually isn't their strong suit. And so this is this kind of how that works. And after you raise a certain amount of money, there's the more money you're managing, the more the shallower the pool of potential investments become. And it can become very difficult, at the margins, to get involved in some of these smaller situations, which might be adequately priced. Oh, sorry, advantageously priced. And this is kind of like one of the opportunities as the retail investor, is you're able to fish in places that they can't or won't go. And so, I was having coffee with a a fund manager a few months ago, and we're kind of talking about more liquid ideas. And my idea of illiquidity was a couple of hundred, maybe 1,000 shares trade a day. And his idea of low liquidity was the average daily volume being 5 million. And he's like, oh, well, we're looking at some more liquid stuff. The ADV's 5 million. And I'm thinking about something that's trading like $50,000 worth of shares a day on a on a good day. And so the problems they're trying to solve are um are just remarkably different at the fund sense. And so, this kind of mismatch, uh, just it manifests. So the extent to which you're not, not running hundreds of millions of dollars, and and you're following 13Fs and trying to keep up to date on what large fund managers are doing. It's not a complete waste of time, but I wouldn't be spending a significant amount of time doing this, um, especially after you've got a bit of uh, yeah, you got a bit of experience under your belt, and a bit of capital, and you can sort of isolate places in which you can you can think you can have an edge and have some expertise. Um, so yeah, it's always interest, it's always a headline and that kind of thing. Um, Probably the other thing, I just mentioned about, this kind of like mimetic, um, mimetic, lemming-like behavior in people is that, especially when you're much newer in the game, um, it's quite comforting to find ideas and community with other people who own the same securities as you, and it's also quite comforting for other people to give you ideas that you can go and buy. Like when you're brand new, like the most exciting thing is buying a new position, et cetera, et cetera, et cetera. Um, and there's like an unavoidable part in which at the start of any learning curve, you're going to copy other people and you're going to rely on other people to some extent, for research and for ideas and for style and for strategy. And the important thing is to not stay there forever. It's to develop your own internal convictions, things that make sense to you. The best way is obviously to have skin in the game and money on the line, and you can learn how you'll react in certain situations and what kind of business models make sense to you. One of the unfortunate things about, like, one of the shortcomings of people who have like never worked in a quote unquote real business before, but people have just might have gone to uni and done commerce, and then they did banking, and now they go into like a buy side role or something like that. Is that they're quite familiar with the business of financial services, but outside of that, outside of this kind of monk like existence, you don't get the full gamut of experiences of what it's like to um, work in some of these other business lines, like a software company or a manufacturing company, or whatever it might be. And like the job of investing is, usually there's a part where that kind of lines up very nicely with actually having expertise in something, because you're going to see things that other people don't see. And so there's benefits from coming from the outside. There's also negatives. Might be much weaker on things like accounting, governance, register dynamics, technical details of who owns what and who might be selling, who might be buying, this kind of thing. This back narrative, which is it's very apparent to people who work in the industry, but people who work outside of it, yeah, it can be jarring, and you might not expect it. So yeah, that's kind of like the 13F spiel, and it might be like, what are you going to do? What are you going to do instead? And pin down a few ideas. Obviously, this is not an exhaustive list by any means of the imagination. These are kind of some things that have been helpful for me over time. Um, the first one would be, and again, this is like, and sorry, just to touch one more point back on the professional angle, from what I've gleaned from meeting quite a few very, very smart, talented people, is that it's quite often striking, if you talk to the analysts and the PMs, so the guys doing the research and making the buy sell decisions, is that my favorite question to ask is, are you allowed to run a personal account, a PA? And quite often the answer is yes. And that's very interesting. And I would like to know what they own in their personal account. And this is not a slight at all. This is just an observation. Is that typically the way a person will run their personal account will be remarkably different from the way that the fund that they either are running or that they work out that they work out. Excuse me. Usually the way they run their PL will be remarkably different. There might be an overlap, um, but typically, you'll have, yeah, like in a fund, you'll need to own a certain number of positions, and you'll have caps on what position sizing can be and how large they can become if they do well, and there'll be rebalancing strategies and blah blah blah, on and on down the line. All that stuff's usually thrown out, and my strong, to the extent that, and to be fair, some of these people have you might have a family, so you might have a lot of your assets in a house, and there's absolutely nothing wrong with that. That's a reality of life. Um, and they might have a significant amount of their assets in the fund. That's if you're a principal, that's quite often the case. You're to to sell the fund. It's a great thing to have. To eat your own cooking. As you get down the kind of low, the ladder towards the people doing the work. So the investment work, not necessarily the most important work, or whatever, but people doing the investment work, and so they don't necessarily have an equity stake, and they don't have significant life commitments. Typically, you find that they have a very concentrated personal portfolio, which two or three of the positions might be big positions in the fund because they know it very well, and then they might own some like very liquid, off the beaten track type stuff. That's very typical. So it's just like an observation. Whereas, like when you know what you're doing, it's when people know what they're doing and they've had a successful personal track record, it's interesting as to how they allocate their own personal resources. Just an interesting observation. So, and it makes sense. Makes sense if you're constrained in all these ways. Of course, the way that you'd manage assets for other people are going to be very different than when it's just your own money, and your risk profile is very different from someone who might have a lot of dependents and have to shoulder a lot of costs, and certainly someone who's not much further on in their career. I can tell you personally, if I were worth several billion dollars, um, would I be so interested in flicking through many oddball situations all across the world? I'm not sure. I'm not sure. You know, I might not have the same motivation for the game. I don't know. I'll have to answer that question when I get there. Um, so, anyways, what do you do instead? Um, so at the beginning, look, obviously you want to consume a bunch of media, and there's a whole bunch of very famous people who have been very successful and there's a thousand different ways to cut up the cake. Skin the cat. There's a thousand ways. And for the most part, there are things that are obviously not going to work. Um, obviously, that are not going to work. There are some things which have a very high probability of not working. Um, and then there are things that will only work for some period of time. And so, like you can kind of take, your Buffett's example, his early career, when he was managing his own money, and then when he started managing the initial partnership stake, and he's doing a lot of basically, yeah, he ran three or four kind of separate strategies, but most of the things he was looking at were very illiquid, small and micro cap situations, and he was doing activism. He was taking control stakes in businesses, so taking over businesses. He was participating in liquidations. He was doing risk arbitrage. Um, and he was also, he also dabbled in what he called, generals, which were, companies that were generally undervalued for the most part. And so, like, that's kind of like a precursor to his later kind of quality growth thing that he's morphed into these days. Um, and so a lot of these like very illiquid net type situations, they went away. over time. And even the risk arbitrage stuff, even he would say that, after about the late 1980s or so, with the amount of money that he was working with, the risk arbitrage opportunities also kind of like dissipated. Um, and so, like the modern version of this, like people love having this conversation about what would Buffett do if he were alive today. And my strong suspicion is that he would have been doing crypto arbitrage or something like that, arbitraging different exchange rates for cryptocurrencies across, decentralized exchanges and yield farming and kind of going to the least efficient markets possible. That's kind of my opinion on that. But even those opportunities don't last forever. The opportunities in kind of crypto arbitrage in the COVID, immediately post COVID period. I know some people who made an enormous amount of money doing that. And some of those arbitrage plays are, not as plentiful or as obvious as they are today. So some of these strategies, they peter out over time, and you have to pivot. And certainly, the more money that you're working with, the more this becomes true. Um, the more this becomes true. And so there's strategies that have like a low probability of working, but you have a certain skill set that meets the time, and that can work. And then there's strategies that have kind of they've worked for a long time. They've worked for like time immemorial. So um, we have sort of 50, 100 years of data suggesting that quantitative value does work. That the inputs to calculate that have changed over time, just due to the nature of accounting and how businesses have been structured. So the kind of price to book, the low price to book strategy has stopped working in the last couple of decades because many businesses have stopped being as capital intensive as they were. They've been also, the economy's rewired, especially in developed markets. And so that is a signal, kind of petered out. But this kind of good and cheap kind of Joel Greenblatt type thing has seemed to persist for quite a while. But in the whole, with mental flexibility and the ability to update your accounting models, paying a lot less for something than it's worth, and that's a loaded statement. There's a lot involved in that, but that has seemed to persisted very well over time. Uh, Buying a cash flow stream for much less than the risk free rate and whatever absolute IRR it'll print out in that kind of has to be true for forever. Only if businesses stopped being the primary economic engine would that kind of go away. But even then, you can apply this to bonds and so on. So that kind of idea has persisted. Probably the other one on a longer term basis has been momentum. Momentum over shorter periods has gotten more challenged, you know, in the last couple of decades, but sort of long only momentum has done fine. And then to the extent that people have taken the ideas of momentum and then applied them to less efficient markets, a la cryptocurrency, it's done, just tremendously well. But I won't spend too much time talking about quantitative factors because I don't spend a lot of time doing that or find that very interesting. But the important thing at the start is to try out a few of these things and find the one that meshes most closely with your personality. And there's a lot of trial and error involved in that. And you might change things over time, and that's fine. But picking something that you can do for a long period of time is incredibly important. And to reiterate, having it be based on sound principles and the you can repeat that process for a long period of time, and that there are like timeless principles that it's built on, which can be molded to whatever the current environment becomes, whether that be fundamental investing or otherwise. Um, Personally, I edge towards the more Joel Greenblatt slash Buffett type approach to things. So trying to find mispriced businesses based on normalized earnings power. The normalized earnings power bit is the loaded part, and it can't be reduced to a formula. That's the bottom line to some of these things. When, like I mentioned, when you're starting off with some of these things, it's very alluring to try and want to reduce everything down to a formula. And the world just doesn't work like that, especially in business. Peter Thiel has this great quote, which is that the every moment in business happens only once. And, that is very true. A lot of things that happen in business occur only once and at one point in time. And things might very well be, uh, things might rhyme over time. Things look similar, and that's been a big part of my strategy is simply to study things that have worked, really, really well in the past and then apply them um, to present situations that look very similar. Um, and I would say that's a tremendous way to go about things. That's been, yeah, I can't even begin to, uh, you know, tell you how valuable studying case studies in the past and applying that to present situations has been. You should definitely do that. I can't recommend anything. I can't recommend anything more, especially in the kind of fundamental sort of long only iteration of this. There's other things, on the vein of what's worked in the past, what might work in the future. It's pretty striking how it's pretty striking how many people who have been successful doing this kind of thing, how much their approaches have rhymed. So the paying a low price thing is eternal. Now, what is a low price? That's kind of like a historical question. You have to answer at any particular given moment in time. But there are very absolute ways that you can reduce that. Very very low EV to EBIT, high normalized, a buyback yield or shareholder yield, or things of that nature. You just can't get around, like the philosophical idea that the lower you buy something as compared to its value, simultaneously the less risk you're taking on and the more return potential you have. This is kind of like an immutable, um, an eternal principle. It's also striking to me how many people have been very successful, have had relatively concentrated portfolios. Um, and my strong suspicion for why people tend to be successful doing something like this is that uh, when you're concentrated, you have to you can't run a concentrated strategy with a lot of downside risk. That's not to say that you might not take enormous drawdowns. I think pretty much anyone who does this for a long period of time is going to have some big drawdowns. That's um that's just part of the game, especially in public equities. But to the extent that you are successful in running a concentrated portfolio, it's probably because you're very focused on a very small number of companies. You're very aware of what risks um, are available to them, and your bar for inclusion in the portfolio is going to be higher. So, all things being equal, and this kind of assumes that you're also talented at this, and there's no guarantee of that. You might just not be very good, and your natural innate skill set might lend itself to something else. That's also very true. That's not to say that you can't work on your skills over time, but um, you might just not be built for this. Um, yeah, so concentration is something, specialization. So being an expert in, like, it's striking me some people are expert in like one company and do really well. Um, there's some people have built entire careers off of just owning Berkshire Hathaway, which is like whatever. Maybe it's like a management fee grift or whatever, but a lot of people have made a lot of money just owning that. You could kind of roll this out like Ackman is a restaurant real estate kind of a specialist, if you will, and those are terrible industries. Um, Generally, like ROEs across the board, and he's had like a tremendous career. Yeah, investing in some of these things, like general growth properties, maybe one of the greatest investments done in a public vehicle ever. Um, so specializing in things is a very obvious path of many people who have been successful over a long period of time. Again, yeah, quantitatively cheap is also something that seems to bind a lot of these people together. uh, Longer holding periods. So this isn't necessarily holding something forever, but the shorter your holding period as a fundamental long only investor is, the longer that you can hold on to things, probably the better. um, if you're holding on to things for the shorter the period, the more you're going to incur in terms of costs, spreads. Categorically, probably the less you hold something, the less likely you are to benefit from compounding in that one business, and the more prone you're going to be to making a lot of mistakes. If you're making one decision a year versus 100 decisions a year, I would be willing to bet a lot of money that the analysis you do on the one idea is going to be far better than the analysis as a whole that you do on the 100 ideas. There's there's gives and takes in this. You could be a specialist in an industry which is just bad and undergoing, a lot of competitive pressures and a lot of capital destruction, and that might just be bad for you, and you just don't have good opportunities. And I think the way that people generally approach this is that they specialize in an industry with good competitive dynamics, and that have some good businesses in them, and then you can pick more than one. And the one that you pick is probably something that you have some kind of first-hand experience in, or you've done an especially large amount of study. You're attracted to it for just innate reasons. Um, if you're like a sector specialist because someone told you to do it because you work on the sell side at some big bank, I'm typically the great analysis doesn't come out of there because that person might just not be interested in industrials. Um, So the derivative of this is focus. After you've gone through the trenches and taken a few arrows, and you got a few wounds, you can, and you've kind of identified an approach that works for you, and you can specialize in some things. Um, the important thing is to apply focus to that approach. Probably the more focused you can be, the better. And I'd err on the side of more focus rather than less. Um, Peter Thiel, as always, had some good quotes about this. This is something Buffett has mentioned. This is something that Bill Gates has mentioned. Many, 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 many successful entrepreneurs have mentioned this. Even someone like Alex Hormozy mentions this as well. And it's just the longer and more applied your focus can be to any one endeavor, the better the returns you'll have on that. So it's probably not the best idea to be doing you know very just purely low quantitative strategies, and then you're also doing merger arb, and then you're also doing quality fundamental long, and then you're also doing long short. um, And the reason for that is that you will just never get very good at any of them. You want to be, work on your craft towards becoming an expert on a particular approach. And you'll only get there through focus. You won't get anywhere if you put 5% of your effort into 20 different strategies. You want to put 110% of your effort into one particular strategy and get exceptionally good at that. And you want to apply study to that. You want to persist at that. You want to have genuine curiosity while you pursue this. But the most important thing is to focus, and to focus on, to continue to refine that. So not only is it focus on a strategy, but also focus on a universe of names that you can understand, genuinely understand, and you can continue to build some expertise in over time. I'd really recommend that there's absolutely nothing wrong with just being like a retail analyst. There's absolutely nothing wrong with that. There's nothing wrong with being a micro cap specialist in a certain geography. There's nothing wrong in focusing on certain business models. There's absolutely nothing wrong with that. That's there's probably two places where you're going to find an edge in some of these things, and one of them is just a bunch of very idiosyncratic circumstances have occurred, which have structurally meant that the people selling that security are like don't they're non-economic. So this is like the classic spin-off demutualization, um, fallen angel IPO, orphaned security type thing. A bunch of technical factors have meant that people have had to sell this, and they don't necessarily understand the value. That's like a very timeless place to go and look for edge. The other place is expertise. So you're going to see something that's very different than how the majority of the market is seeing something, and you'll be pretty surprised. Um, so long as you have legitimately done the work, you understand the history, you understand the people involved, you understand the regulatory environment, all this you apply and your focus and energies, you'll be very surprised at how few people have done the same. Very surprised. Um, if you've done work like this, you're kind of across geographies for the most part, you'll be surprised how few people in some foreign geographies don't even understand how these sorry, people in the local geography, you're a foreigner, even they don't understand how some of these things have developed. This is very common. um, and this edge can even apply to mega cap names. If you've done significant work on Amazon, if you've spent significant time working through their retail business and their AWS business and their chips business, and what's Amazon's strategy? How did they come, to this point the way they are? How did the business model in the early days differ from the business model that's happening now? What are the motivations behind the people who are running it? What is Bezos leaving and partying most of the year and doing a $50 million wedding with his mistress? How is that affected the nature, and how is the new CEO remunerated, and what was his background, and what were the political struggles that happened between the executives when Jazzy became CEO? Who left? What implications did that have for the retail arm? What implications is AI having for their business? What's their strategy with AI? They're big in inference. They're building their own chips. They're trying to be multimodal. What does this mean for their warehouse, and so on? The extent to which any single analyst has considered a lot of this stuff in very deep detail is vanishingly small, and there's no that's no knock on anyone. Flows these days are really dominated by the index funds, who are indifferent. They don't care. They have an algorithmic model for buying and selling securities. And then a lot of the marginal bid in securities is pods these days. Uh, George Haggia, I hope I'm pronounced that right, Australian fund manager. I'll link to his blog, which is Bristlemoon. He had a great article on this the other day, which was basically talking about how pods, quote unquote pods, which are long short hedge funds for the most part and pretty short term money, how they're aside from the dynamics of the index fund bid, how they are pushing up and down security prices depending on a shorter and shorter time period, and how the long short strategy within that can punish and reward certain themes at any given point in time. And if you're in the pod environment, like, what do you care about? um, you know uh, Amazon, like, why did Amazon raise a bunch of debt financing in 2001, 2000, and 2002? Like, why did I think it was a convertible? Why did they do that? They don't care. It's irrelevant to the story for this quarter, or the next 2 quarters, maybe like 6 months at the most. Um, do they really care, that you know do they really care that much, like that, Moody's Analytics, that their software businesses and databases are probably not as exposed to, like the AI fear that, some of SPGI's worse businesses might be exposed to it. And so, like they don't care about that. They're just short, hot money, long and short, trying to be long the most successful theme for the next, X number of weeks and try to be, and do it on the other side, uh, as well. And like the life cycle of a lot of pod guys is like, you could probably measure it in 6 month increments. So I wouldn't, that's kind of, yeah, we'll kind of see how long that whole thing persists. But this stuff just doesn't matter to a whole bunch of market participants in any event. The edges available in this kind of stuff persist in time. At the end of the day, if you are trying to buy something for less than it's worth over a long period of time, some of these market dynamics can work in your favor from time to time. Okay, so yeah, focus is so key. I can't press it enough. Yeah, if you're like a really young guy or gal, it's not going to mean much to you, but the returns for focus are exponential over your lifetime. And the more that you can focus on something, and the more that you can hone your craft and hone your expertise, and the extent that that can link up with something that you're genuinely interested in, that's where the magic happens. Um, okay, so other things aside from like looking at 13Fs and shit posting on Twitter all day, building a genuine network is massive. I can't even begin to describe how valuable this is. And this is again, this is like a compounding thing in and of itself. Um, Again, to the extent that you're not, working at a fund and you're not conflicted and you can't like not have a Twitter account and your boss is going to figure out, what you've been saying on the timeline. The extent to which you can post on Twitter about, your insights and your ideas, and the extent to which you can, write blog articles. If you're a young person trying to get into the industry or just whatever, you're, just generally interested in running your PA for a long period of time. I think running a blog is a great idea, independently of whether or not you want to monetize it or not. It's a great way to have, you know, um, build up capital with other people and have them reach out to you, DM you. You can meeting a lot of these people is great. Like usually people who are on Twitter and who are reading like blog articles, one they can read. I think like the number of people who are literate, it's going to sound pretty crazy, but I think it's extremely low. And the number of people who are literate and who have like a long enough attention span to read a couple of 1,000 word article blog, I think you're getting to like a very small minority of very interested and committed persons. And that filter of having these people, and it doesn't matter, like you shouldn't be self-conscious about whether your ideas are good or not. I remember when I first started writing my first blog on 13F'S, I go back and read it every now and then. It's like, pretty embarrassing or whatever, but it just doesn't matter. Like, as long as you're getting better, that's the important thing. The important thing is not that you're like a 19-year-old or 21 or 25 or 30 or whatever 5-year-old guy that has like, bad insights. The important part is that you can just get better. Um, and people will appreciate, your insights and your take, irrespective, especially if you've done a good amount of work. People will appreciate that, and they will, and quite often they'll hit you back, and you might, yeah, I've had several heaps of guys. Unfortunately, not I don't think I've met any women. I know my audience is like almost all men, so I haven't met that many gals who are that interested in it. But I've met like a bunch of friends for many years now, shared a lot of ideas, shared a lot of intelligence. The great thing, if you're not well infrastructured and you don't have a ton of money for like alpha cents and various subscriptions and stuff like that, is that if you put out your honest work, a lot of people will come back and say, hey, look, here's this sell side article. Hey, look, here's this here's this Tegas transcript, you might find it interesting. And those things can be like pure gold and pure gold. And like I would pay for some of the, like it'd be worth paying for some of these relationships. So I really recommend it. Um, so yeah, look, yeah, a lot of the people who are going to hit you back are professionals because they've like this is their job, right? The one of the big drawbacks of being a retail investor, and certainly not like an independently wealthy retail investor, is just the amount of time you can put towards this. It's a bit of a conundrum actually, because this is really not something you should do like part time. It's a very fun hobby. Like, it was a hobby for me. It's still a hobby for me. Um, but the extent you're trying to do this while working a 9 to 5 and you're committed to being like, good at your 9 to 5, it's very hard to do both together and best to be done when you're younger. Don't try and be doing this when you're older. Um, and so, yeah, look, a lot of the people who hit you back are pros. Um, and those relationships are gold and they can be very long term and beneficial to everyone. Yeah, so writing a blog's good, posting on X is good. You know, uh, X and Substack are probably my favorite mediums. This is absolutely no insult to anyone, but I'll just say, like, the people who are on Twitter, they're really interested. People who are like finance people who are not on Twitter, my feeling is that they're actually just like not that committed to the game. When you meet some of these people, but like people who are like, on Twitter in the trenches posting about names under anonymous hashtags and like they got 15 followers and they DM you about some name, like those are like the really, really good connections to try and make. The unfortunate thing about the time period we're in now is that, Twitter is, it's changed a lot since COVID and the amount of time that people have to put towards like, they're not at home as much. They're traveling more. They can't be on Twitter they can't be on Twitter like 20 hours a day like it was back in 2020, which was like the golden age. And a lot of the other bad thing about good investors is that they get wealthy, um, over a couple of decade, couple of decades, that kind of thing. Even if you're just running a relatively small amount of your money, and once you get wealthy, you probably don't, you're not as committed to the game anymore. Even if you really do love it, you've got other things to do. You're raising kids, you're traveling, whatever you might, pull back on over indexing on your investing. So kind of have a new crop of people pop up all the time, which is, well, it's a good thing. It's a good thing and a bad thing. So Substack's great. Yeah, my opinion on this is, look, if you're really interested in this, look, like start a Substack, just start it, start posting articles. You're going to attract other like minds, and you have no idea where that can. I know so many people who have started their career doing that. So if you're like interested in getting into the game in a serious way, I can't recommend writing blog posts more. Um, it's a way for you to have like a almost peer-to-peer like relationship with actually professional guys and people who are running funds. They can kind of get a glimpse of the quality of your work and the way you think and all those kind of things. And plenty of people have landed a job writing that. I would massively probably just like anyone who messages you off LinkedIn, maybe you could just like straight up block them. Those people are for the most part not that serious. As opposed to like where else there are like financial communities, outside of Substack and X. There's not that many. Places like Value Investors Club are good for popping up ideas, but the sort of the connections you can make on there not that great. Um, So yeah, networks are incredibly important and powerful, and yeah, I can't recommend investing in that enough. Uh, Build conviction in yourself. Yeah, obviously, thing that most new people fall into is that you don't necessarily have conviction in yourself, and that's because you don't have confidence, and that's because you don't have evidence of your competency, and that's just something you have to work through when you're newer to the game, and even several points along, even as you get further into this, your confidence will be challenged many times over. um, And the important thing, is, at the beginning, you want to get away from, relying on the insights of others. I don't mean to not, I subscribe to many paid Substacks. I'm on Twitter all day. It's great. I check Value Investors Club, Seeking Alpha, Run Screen, you name it. Meet smart people, chat with them about ideas, and so on. And those are very good top of the funnel things to invest in, and I would recommend investing in them, and I do. Um, and so, using those things as the top of the funnel to get ideas, into your process is really good. But at the end of the day, like, as a money earner and a custodian of your family's resources or your own resources or whatever it is, you have to build the conviction yourself to buy, sell, sell a little bit, buy some more, make judgment calls. And you're not, like, by its very nature, you're not going to be right 100% of the time. You're not going to be wrong 100% of the time. It'll be somewhere in between. But the important thing is that you build conviction and confidence in yourself. Because if you lose that, that that's that'll be unsustainable over a lifetime. Doesn't mean you can't change your mind. Doesn't mean that you can't, you know, bounce ideas off with other people and that kind of thing. But at the end of the day, you need to do the work. You need to have the conviction. You need to build confidence in yourself so that you can pull the trigger. So important. Um, yeah, okay. This is probably another one, which is like, again, this is only applicable uh, to people investing in their own PA, basically. But you want to finance yourself for success. What do I mean by this? This is not like a personal finance channel, but there's better and worse ways to go about this. So, maybe you're working in the industry, maybe you're not, maybe you got a normal job, whatever, you run your own business, whatever. If you run your own business, you'll know this, this stuff like the back of your hand anyway. But um, the important thing, really an important thing is to not live out of your personal account at the beginning. You want to find ways to smartly finance your personal account, and usually that looks like living within your means and saving the difference. This is not to say that you should, like, live like a hermit and all these kind of things, although that might be helpful for a time in your life, for a season in your life. But the proper way to have a PA is to have a pool of assets that you manage, and then to have incremental capital coming into the PA and not having incremental capital leave your personal account. And you kind of, like, this is, like, there's many innovations and brilliant things that Buffett's done over the years, but this is one of the genius principles of Berkshire, is that, look, they have businesses that throw off cash. That cash can be allocated into other businesses. It can be allocated to private investments, can be allocated to public investments. And they've, importantly, in the early days, they had the insurance operation. So the insurance operation was a way for them to access, essentially low, no, and at certain periods, positive carry a debt, money that's not theirs. They're able to access money that they were, for stretches that they were getting paid to hold on to. And so, like, in the case of your personal account, the way to replicate that, this brilliance, is to have incremental money come into the PA very regularly. And this will, this is like, this will give you capital flexibility. You won't have to sell things in the event that interesting opportunities come by, and you don't want to make like a hard and fast decision between investment alternatives. It will, at the start, it's very likely you will be bad and lose money. And so, having money come in will be psychologically helpful in that regard and might help you persist. And when those things are in reverse, when money's leaving, all these psychological things become difficult. You might have to sell positions and take on tax liabilities if you need to. You take money out of it. So any of the money that's going into your PA, in an ideal world, right? And this doesn't apply to everyone and not at every point in your life. And maybe you need the money for a house at some point, whatever. But at the end of the day, like, you want to build up a pool of resources and you want that to compound. The way to get in front, the way to ruin your compounding is to take your money out. And so you want money to stay in and compound for a long period of time, and then you want additional money to enter uh, over your lifetime. That would be a very smart way to go about things. And so when you finance yourself like that, you're just going to have a much higher chance of success. Um, right? Yeah, I'm not saying anything revolutionary here, but long termism is so key. And when you're younger, this is not, like you think you're going to live forever and you're going to be 21 forever and all these things, but you'll be disabused of that notion in time. Um, uh, Long-termism is having long-term goals or a long-term direction and persisting at actions over a long period of time. This doesn't necessarily mean that you have like indefinite holding periods. Um, this would be a key mistake of mine. In fact, having this kind of a Buffett like never sell, which is not what he does anyway. But kind of defaulting to, yeah, I'm just never going to sell this security. That is, I think that's lazy. That's lazy analysis for the most part. You're not Buffett. You probably don't have his skill set or his foresight. And many contingent circumstances happen over time. And the important thing is that you kind of stick to your guns and your process and your judgment. Doesn't necessarily mean that selling things is over a short period of time is a bad thing to do. Again, there's better and worse ways to do things. You don't want to be doing this as a rule, but for the most part, you want to be led by opportunism. So when the market gives you a very high expected value opportunity, you want to take advantage of that. So that might be a very mispriced security for one reason or another, or what you think is a mispriced security. And then on the other side of this, um, like you might get an opportunity to sell something in the market which is very mispriced on the other side. So, it might be a very high opportunity that you don't see a price like that again for quite a while. And you'll have to measure that against other opportunities that are coming in. Um, and having that kind of mentality is not inconsistent with long-termism. It's consistent with just a rational approach to allocating your resources. Yeah. So in that vein, remain flexible. A lot of these things are like kind of, they appear to be like a conundrum, and it's like a double negative. Be long term, but also remain flexible. But you don't want to rigidly hang on to things that are no longer real, are no longer a reality. And that can come in many different forms, because life is just a bunch of circumstances and a continual stream of dynamic occurrences. And your job as a you know your family's custodian of wealth, or your role as a moneymaker, or whatever it may be, is to assess these opportunities and changing dynamics as they happen. Um, and so, yeah, remaining flexible, having some of these timeless principles but applying them to new situations is extremely helpful. So look, hopefully that was informative. Those are just some of my observations, and yeah, I'll chat again next week.